Hey everyone, welcome back to Corporate Decoder, the place where we decode the insider secrets of the corporate world, maybe with a little too much borrowed money. Today we're diving into Moatable Inc.'s latest filing, a Form 8K, which tells us about a pretty significant financial move they just made. This isn't a full quarterly report, but it's giving us a peek behind the curtain at a new loan agreement. If you appreciate getting straight insights from corporate documents, make sure you're subscribed and, hey, join our Discord community linked in the description below to talk about this stuff all the time. So Moatable Inc., this is a company that's involved in the transportation tech space, think trucking and logistics. They're publicly traded and today's document is all about them taking on new debt. It looks like Moatable has arranged quite a substantial loan for its subsidiaries, specifically Moatable US Holdco, Inc., Lofty Inc., and Trucker Path Inc. are the ones borrowing the money. They've secured a new credit facility, which is basically a loan agreement totaling $9.75 million. This isn't pocket change, and it's called a senior secured credit facility. What that means is this loan is a top priority if the company runs into trouble, and it's backed by specific assets, making it less risky for the lender and therefore usually a bit cheaper for the borrower. The lender in this deal is PNC Bank, a big name in the banking world. Now, why are they taking on this debt? The really interesting part is how they plan to use the money. A big chunk of it is earmarked for buying back their own stock, specifically Class A ordinary shares. This is happening as part of a tender offer, which is essentially a public invitation to shareholders to sell their shares back to the company at a set price. In this case, they're offering 3 tonsegolens per share or per American depositary share, which represents a bundle of their ordinary shares. They're looking to buy back quite a lot of stock, up to 225 million shares. This move, borrowing money to buy back stock, can be a sign of a few things. Sometimes it means the company believes its own stock is undervalued, so they're investing in themselves. It can also be a way to boost earnings per share by reducing the total number of shares outstanding. This loan isn't a forever thing. It's set to mature on October 31, 2026. That gives them a little over a year to manage this debt. Let's talk about the cost of this borrowed money. The interest rate is tied to something called Daily Simple SOFR plus a 130% margin and an additional 0.1% credit spread adjustment. SOFR is a benchmark interest rate that tends to be a good indicator of short-term borrowing costs. Adding those percentages together gives us the actual interest rate. While the exact number fluctuates with SOFR, this setup means the interest rate will likely be higher than just a fixed rate because it's tied to a variable market rate. They're also paying a 15% commitment fee on any money under this facility that they don't use. It's like paying a fee to have the money available even if you don't touch it all. A positive note here is that they can pay back the loan early without penalties. This gives them flexibility if their cash flow improves or if they secure cheaper financing elsewhere. This is a really significant detail. Being 100% cash collateralized means they've had to put up an equivalent amount of cash to back this loan. Think of it like a security deposit for the bank. They also have to set up an interest reserve, which is essentially setting aside enough cash to cover 3 months of interest payments. This is a strong indicator that the lender wanted a lot of assurance given how they plan to use the funds. Like most big loan agreements, this one comes with a bunch of rules. These are called covenants. They include promises about not taking on too much more debt, not selling off key assets without permission, limiting who they can do business with or how they do business with them, and restrictions on paying out dividends or buying back more stock. These are designed to protect the lender by keeping the borrower in a stable financial position, and of course there are default clauses. If Moatable breaks one of these rules and doesn't fix it in time, the interest rate jumps up by 2% per year. That's a pretty steep penalty. This filing also lists the actual documents that make up this deal, like the loan agreement itself, the promissory note, and a pledge agreement which details what assets are being used as collateral. These exhibits are important for the really granular details, but for us, the summary tells the main story. This section just confirms that indeed this new loan is now a direct financial responsibility for the company. It's right there on their books. And finally, this is where they list all the supporting documents they've filed along with this report. Now, looking at this situation with Moatable, it's a mixed bag. On one hand, borrowing $9.75 million to buy back stock can signal confidence in their own future and a desire to make their remaining shares more valuable. The fact that they're using subsidiaries as borrowers and collateralizing the loan heavily suggests a calculated move designed to manage risk and perhaps attract favorable borrowing terms from PNC. The structure of the loan, with its SOFR-based interest rate and commitment fees, is pretty standard for corporate finance today. However, they're taking on debt, especially when the stated purpose is stock buybacks, always warrants caution. It increases their financial leverage, meaning they have more debt obligations to manage. If their business performance falters, that debt could become a significant burden. The 100% cash collateralization and the interest reserve requirement are particular note substantial security. This isn't necessarily a sign of immediate trouble, but it's a clear indicator of the lender's risk assessment. The company is essentially betting that the value they create by buying back shares at $3 errors will outweigh the cost of borrowing and the associated risks and fees. The strategy needs to pay off quickly if the market doesn't respond favorably to the buyback, or if the company's core operations don't generate enough cash to service this new debt comfortably. They could find themselves in a tight spot, especially given the potential for interest rate hikes. It's a bold move and one that investors will be watching closely to see if it contributes to long-term shareholder value or just adds to their financial obligations. What's your take on Moatable borrowing money to buy back shares? Do you think it's a smart move or a risky gamble? Let me know your thoughts in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more of these corporate deep dives. And don't forget to join our Discord to keep the conversation going. Thanks for watching, and we'll see you in the next Decode.